From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, May 22nd. Welcome back to the Macrocast. This is Tony Fratto. I'm back in New York City for the first time for the Macrocast in quite a while, almost about 2 months now. John Fagan, Brendan Walsh, our partners from Markets Policy Partners, are in the DC area. Guys, an interesting week. We had the buddy movie with Powell and Mnuchin. In the same way that Bernanke, Geithner, and Paulson will always sort of be joined at the hip. Mnuchin and Powell, their fortunes, the way we're going to look back on how they performed this period, are going to be sort of thought together also. So having them together on Tuesday testifying before Congress on the CARES Act and how the CARES Act is being implemented and effectiveness. We had that earlier this week. We had the rollout of the 20-year. We had jobs, initial jobless claims yesterday. Again, it's still pretty high number. And some news on the outlook. We had China tensions rising. We're going to get to later today. Later in our second segment. Some European news, but let's start with Mnuchin. His sort of big week. I think when we talked about this before, he said kind of put a stamp on it with the 20-year, and it occurred to me that we'll never forget the day that the 20-year auction was first. It had its first auction, or the amount, because it was $20 billion on May 20th. 2020, and it was the 20-year duration. So I don't think those were coincidences.
For all you numerologists out there,
exactly,
to find the significance in that.
Yeah.
Well, the traders found significance in it. It was a really good auction, and it not only went off well, but it also rallied the 10-year and the 30-year on both sides of it rallied. There was there's always concern with these when you're putting a new point on the Treasury yield curve that it's going to come at the expense of the 30-year, and the 30-year is, you don't want it to. There are always concerns about whether if you start adding more duration out there, whether it's going to get a little unstable. Kind of like we've joked about the idea of if you went out to 50 or 100 years, the idea that really increases the risk that the end of this ultra long duration end of the yield curve becomes like an unstable trailer at the back of your truck. Kind of.
No, but John, that's a really important point. We talk about the market responses to these things, but within the Treasury, how does this decision get made? This is fairly unprecedented, and they decided to do a 20. How does this process go about?
Well, it's very deliberative. I mean, they are engaged, and certainly the process is long. They have exhaustive amounts of consultation, both through the Treasury Borrowing Advisory Committee, which is a board of luminaries that advise the Treasury on these things, but their unofficial engagements are enormous, and they certainly have a crack team there crunching the numbers and trying to make sure that they know where the demand is. And Secretary Mnuchin alluded to that when he was asked about the new issuance in his testimony on Tuesday. He said that he had not opted to issue a 50 and 100-year bond because the demand wasn't there. And it's very consistent with what the TBAC and other, market, temperature checks have shown over the years, which is the enthusiasm for a 50 and 100-year bond tends to be on the policy sphere. Let's borrow long, lock in these long interest rates. It sounds right, but the market really just isn't necessarily ready to digest it. The 20 kind of had, it shouldered its way in there between the 10 and the 30-year, and had a nice debut. Yeah. So that's the kind of conservative activity and successful rollout that the Treasury really wanted to achieve. So tip of the cap.
But Tony, I feel like, this kind of went under the radar, and it wasn't necessary. It went fine. But unless you were in the market, you weren't aware of it. I feel like in your time at the Treasury, you would have had to do a lot of explaining why you were issuing the 20.
Well, look,
now we just throw out $3 trillion in debt and everyone takes it.
Right. My first months at the Treasury, my first borrowing advisory committee meeting that I worked with on quarterly refunding. I mean, so when John was referring to these, the long process, the way these things are done is they are usually introduced as a question for discussion for the Treasury Borrowing Advisory Committee. As John mentioned, it's luminaries who understand debt markets, but also primary dealers. So a lot of the primary dealers, the ones who are going to have to take this product, from the Treasury and distribute it to the global markets. Those are called primary dealers, and it's a large group of financial institutions who do that, and they're on the hook for it if it doesn't sell well, right? That their obligation to be part of this process is they take the product, just like a car dealer, takes product from GM. So that's the way that works. And they put these questions out at these quarterly refunding announcements. That's where Treasury tells the world and market participants what the supply of their product is going to be coming out online. And so they had the most recent one was early in May, and they told the market what kinds of what durations they're going to be putting out, what their issuances are going to be, and what they think their future quarters of borrowing needs are going to be, so the market can be prepared for this to go out and do it. And they put out this question in the 20 years. John mentioned they talked about this question of going out and doing a 40 or a 50 or 100 year has been out there a lot. They keep telling them, look, we get it, it's not for us. And we're not good. That's not something that we're gonna that there's gonna be much appetite for. The 20-year was out there, and they said, look, it might work. Now this is well before COVID, and just to put the borrowing needs for Treasury in context. Treasury borrowed in the late May to the late March to early May period about $1.5 trillion. Right? They've already borrowed this year, three times their entire borrowing from 2019. So that is, these are huge markets, and they're dumping huge amounts of supply. And this is before a phase 4 deal that's, it's going to come in, and we're going to have, more borrowing needs. Now we put off paying taxes too. So we're going to have tax receipts coming in a few months as well that might reduce borrowing needs. But these are enormous needs, big numbers. If you had asked me, before COVID, does a 20-year make sense? I think we talked about it here. I said, whatever. I don't think we really need it, but whatever. Right. It might perfect the pricing of the 10-year to have a 20-year stuck in there, and so that's fine. But it's not a big deal. Now, with this much supply that you need, that you're going to have out there, give the market more options on where they want to take that debt. But it seems like right now, and for this foreseeable future, it seems like, and with the Fed still out there in the market, that the demand seems to be insatiable for U.S. Treasuries.
That's sure what it looks like. Right now, the 10-year is trading in low mid 60 basis point range. 65 basis points this morning, and it really hasn't shown any, even with this flood of supply coming in, it's really shown very minimal upside and reaction to this supply. The Treasury and the Fed must be heartened by this. Clearly the Fed, and we'll get into more of what the Fed is talking about in terms of their future policy, but the Fed is in this market, and And we'll talk about Treasury supply. That also comes up in the context of China as well, given that China is I think the second largest holder. I think Japan has now topped them, the second largest holder of Treasuries. So
of foreign holders, yeah, absolutely.
Yes, of foreign holders, right.
The economic outlook, CBO came out with numbers. I think they're predicting a 38% decline in GDP and Q2. They're only predicting something like something in the order of 15% unemployment, which I think seems low. But look, these numbers are all, as we've said before, they're just big and bad. Like trying to put a fine point on them doesn't really matter all that much. But I think what's clear, even though we're going to, the market seems to be expecting more of a rapid recovery, something with a V shape at the bottom, at least, however long that chart extends out, whether it's continues its pointing upward, or whether it swooshes out like the Nike swoosh. We'll see, but at least a V shape on the bottom. But it seems like no question, and Mnuchin alluded to that this week. Also, more funding is probably going to be necessary, right? We're probably are going to see a phase 4,
especially for the state and local governments.
Yeah, I think there was a little bit of a contrast, in not necessarily in substance, but in emphasis with the secretary's comments, or at least what was most magnified by the reports about it. When he testified alongside Chair Powell on Tuesday, most of the headlines on his commentary were really about his emphasis on how shutdowns will potentially inflict permanent damage to the economy if extended quarantine measures. And also there was he has to toe the Trump administration line that more stimulus is not needed immediately. The sort of pause and wait. He didn't necessarily contradict himself when he came out yesterday morning and say that more is needed, but it's it's just a question of emphasis. So in terms of the buddy dynamic between Chair Powell and Secretary Mnuchin, Powell he's been careful in choosing his words, but he has been consistent in hinting, implying, thinly veiled indications that he is strongly in favor of more fiscal spending, and the faster the better. And we heard that he made a variety of different remarks this week that were to that effect.
Brendan, do markets how are they reading this? The difference between the data and what we're seeing in the economic numbers, and clearly if we're looking for more financial support, if that's coming, are they counting on that? Is that something that will disappoint them if it doesn't come in as fast or as big as they think, or they just think that the organic growth coming out of this following reopening is going to be enough?
It's been interesting, especially with the economic data. So the hard data has been still terrible. Though we are seeing a rebound in the housing activity. People are still going to buy houses. But
it's wild, isn't it? The housing numbers are really they're off the charts, aren't they?
Yeah, especially, we get the weekly data from the Mortgage Bankers Association, and that's really, kind of bounced back to somewhat normal. I think some of it might be a little skewed. People are really trying to rush out of New York and buying houses up in Connecticut to get out of the city. But also, I think that's a reality that we're going to be facing going forward, where people are allowed to telecommute more than they ever were. So you might see a change in the way that we live going forward. But in terms of the market, when you look at the data that we see, especially with the surveys, especially on confidence, the confidence numbers are kind of bouncing back, and people are kind of thinking that we're going to have a vaccine, or we're going to kind of go back to normal in the summer, and probably we're going to cure this by the winter, and maybe we won't have that second wave. So while everything's still very much lower than it was, there is a lot of I think confidence in the market that we've seen the worst of what we've been through. I'm not smart enough to tell you whether that's true or not. I'm, I suppose, a little more cautious, going forward, because I just don't want to be disappointed. But there have been a lot of so the AstraZeneca announcement yesterday, I think, kind of went under the radar of the market. So that's the Oxford trial, where they had a head start because they were already working on the SARS virus. So they just kind of adapted it to COVID. And, in their announcement yesterday, they really think that by October, they can be mass producing, hundreds of millions of vaccines for the world. So basically, to produce 400 million vaccines, they need 40,000 liters of the vaccine. So it's not like millions and millions. Science really is kind of catching up. And human ingenuity, especially because this isn't one place. This is an entire world, fighting this one. So there is reasons for hope. But I think the market is kind of thinking we're talking about like June where this is going to be fine. And the reality is more like, November, December.
Well, I saw I saw some smart aleck on Twitter said that, at least from the standpoint of the equity market, progress toward a vaccine is the new version of progress toward a phase 1 trade deal. It has that same, we saw that all last year. Whenever the markets were down, they would shove Larry Kudlow in front of the cameras and he would say something upbeat about the U.S. progress toward a U.S. China trade deal, and the S&P 500 would immediately go northward. And now that is the self-same dynamic.
But I also saw a stat that I could be wrong, but between all the QEs that are going on in the world, we're buying like $1 billion worth of equities or assets like a minute. It's outrageous what we're doing.
That's a lot of support. Well, look, what the market may or may not be pricing, it also has more tension with China, of which there seems to we're revisiting that this week. Yeah. So why don't we take a break here and come back and dive into China a little bit, because there is a lot moving on that front, and some of it pretty concerning. You're listening to the HPS Macrocast.
Join Brendan Walsh and John Fagan from Markets Policy Partners on Wednesday, May 27th at 10 a.m. for The World from Washington, the first in a series of events they're co-hosting with TIS Group, a global macro research firm. The virtual event, which will also feature HPS founder Tony Fratto, will explore the ever-deepening interconnections between financial markets and policymaking, as well as investors' increasing focus on how the actions of leaders in the U.S. and around the world drive economic outcomes and asset prices. Sign up and learn more at marketspolicy.com.
Okay, and we're back on the Macrocast. Guys, U.S. China tensions on the rise. Again, there's a lot going on here, and we talked. One piece of it is the U.S. China trade deal, and that's actually ironically the sort of the bright light in a way, and that the both sides. That we had the National People's Congress this week, committing to implementation of phase 1 of the trade deal, and Lighthizer put out some good words about Chinese commitment on phase 1. There's a lot other out there. Obviously, the finger pointing and very heated ways on COVID and China's involvement in WHO. And then we had Congress passing a law on delisting Chinese companies who are listed on New York Stock Exchange or NASDAQ, who are not providing enough transparency into their earnings and their books, like lots of other companies have to do. That passed, I think unanimously in the Senate. Is probably going to pass the House as well. And then we have Hong Kong, which Hong Kong was pre-COVID was the hotspot between U.S. and China, and we're back to that now with the Chinese recommending national security. They're calling them national security anti-terrorism laws, but really probably the most direct threat to undermining the one China, two systems policy that has governed Hong Kong for a few decades now. This is the Chinese have been trying to undermine it. This is a very direct and public and open way, and you have to think the timing has something to do with the distraction of the world right now with COVID. China potentially making the assessment that we don't have the time or energy to be dealing with Hong Kong right now. We're going to see big protests in Hong Kong, and this does have an opportunity to re-rupture or deepen the antagonism between the United States and China right now. John, you were an Asia and China analyst. How are you seeing this situation now?
Yeah, thanks, Tony. The headlines really are coming thick and fast over the last few days. Developments is a very fast moving situation, a very swift deterioration in the U.S. China relationship, which obviously had a nice little high watermark there with the signing of the Phase 1 trade deal after all the Sturm and Drang that went into that. But then in the ensuing months with the pandemic, we'd always expected that the Trump administration, once we got through the peak and the maximum danger of maxing out the healthcare system, on the other side of that infection peak would be what we called R&R, recriminations and regulations. And the recrimination phase started quicker, as we expected, and it was pretty clear which way the Trump administration was going to go with this. They were going to be blaming China. They've really over the past few weeks certainly turned up the volume on that front. And just to take a step back, we viewed this really as it's a part of the campaign strategy, of course. I mean, there's certainly legitimate issues behind it, but really, the Trump administration is clearly trying to take a tough on China stance into the election, into the re-election campaign, painting Joe Biden as soft on China. This week, President Trump said China was desperate to get Biden reelected. And given the electoral calculus playing, a meaningful role in this U.S. posture against China, at least this current version of it, our sense is that the administration is going to make sure that they've got their tough on China bona fides together, but at the same time, they have to be wary of red lines in that if they go too far on certain fronts against China, they will get significant market and economic blowback that could then very much further undermine the president's chances of re-election. So our base case is that they're trying to conduct a delicate dance. And this week, that delicate dance got a lot harder with the Senate getting into, we suspect from what we heard around town on Wednesday when the Senate passed with unanimous consent, this bill that could eventually lead to the delisting of Chinese companies, that it was almost a kind of dog caught the car moment. Yeah. They didn't necessarily expect it to pass with unanimous consent. But
and then the House is going to take it up and pass it. This kind of came out of left field. A number of contacts called him like, yeah, I think this is going to happen.
Now, of course, from a public policy standpoint, the bill doesn't call China out specifically. It's it's for companies. You have to submit, you have to claim and pledge that you're not under the control of a foreign government, and then you have to submit your audit for inspection to a body that I didn't even know existed, which was the Public Company Accounting Oversight Board.
That's because you're too young. You don't remember. I'm old enough to remember the creation of Peekaboo. The Public Company Accounting Standards Board.
I'm sure all your friends were clamoring to get in there to make a career out of it.
This is I don't know where you guys were during the accounting scandals, the post equity bubble.
I was graduating college.
Right. So you were not paying attention to Sarbanes-Oxley.
Well, actually, it was kind of ironic because all my friends that did economics accounting, they were the safe ones. They did the boring thing, and they were going to get a job. And then they graduated, and they all were out of a job because everything got laid off.
Well, this delisting bill puts this peekaboo back in the spotlight. But it's also a slow burn. The bill is a slow burn.
But John,
one of the reasons that
it's a transition, and
it's 3 years. Yeah. It's a 3-year window, and that's why Alibaba, Baidu, Sina, all the Chinese, Tencent, the big Chinese ADRs, the American Depository Receipt, the way that Chinese companies list typically on U.S. exchanges, all those really went down very heavily on Wednesday, and then kind of bounced back up as investors got a sense that this is not an immediate next Tuesday delisting, shock to the system, that this is a process that is multi-year.
And even when the bill gets passed, you still have probably 6 to 12 months of meetings and implementation of the bill. So it's really more like 4 years from now.
No, we did have one company that actually was delisted, right?
Yes.
It was Luckin. No, not Luckin.
Luckin Coffee, yeah.
Luckin Coffee,
Luckin is
Luckin
going
Coffee.
to be delisted.
Yeah,
they actually,
and that had nothing to do with the SEC or the Trump administration. That was the NASDAQ that said, you guys are lying about your accounting.
Or NASDAQ, rather. It was NASDAQ.
Yeah. Good old-fashioned fraudulent coffee sales sank them. So they had their trading suspended. It reopened, coincidentally enough, on Wednesday to add to their already 80% losses. NASDAQ announced that they were going to delist them. NASDAQ also announced that they were going to be tightening the accounting standards that they're going to hold the companies that list with them. That is, again, not mandated by the government, but you can see that this is clearly a consensus that is growing. There's a policy consensus here that Chinese companies eventually need to be given a timeline in which they have to submit to a much greater degree of internationally accepted accounting standards, not next Tuesday, but over a period of time. And I think that's the direction of travel is clear.
Exactly. And that's the most important point, I think, that people should understand, that China, it's not a partisan issue. Biden's not going to be weaker than Trump. He's going to go about it in a different way, probably the more, diplomatic path. But there's no huge voting bloc that is looking to get, be pro-China. People are pretty mad about all this. So investors are well, the Trump campaign is going to want to paint China as a dove on China. That's just not the case. Everybody's going to kind of play by the same kind of hawkish rules.
And just as everybody was trying to process this delisting issue, along comes Hong Kong. The National People's Congress this week, the annual major political meeting of the year in Beijing, was delayed from March. And one of the decisions that they made, along with others that are quite notable, one was to impose a security law in Hong Kong from Beijing, and attempts, as we all know, internally to tighten the security situation in Hong Kong. The homegrown legislative attempts to do that met with ferocious protests on the street. The reports are that protests are going to be beginning tonight. This is already 2 senators have put forward a bill.
Yes.
Last year, they already passed a Hong Kong focused bill that basically forces the State Department to do an assessment of Hong Kong autonomy every year. And based on that assessment, whether if they don't pass it, then the U.S. can withdraw a special trading status for Hong Kong. And this new bill would be much more directed at individuals and entities that engaged in the crackdown. It would be going after, their banking activities and that sort of thing, and sanctioning banks that work with those individuals. It's much more expansive. It's much more. It's a much more serious issue, and we'll see how that goes. President Trump was a little oblique about the Hong Kong issue. He has been a little oblique about it in the past. It's kind of been an issue of convenience, it seems, in some ways. He certainly didn't use it as a big cudgel to whack the Chinese during the trade negotiations. That's for sure. He brought it up occasionally, but it didn't really feature. And so we'll see if there's a pivot from here.
You get the sense with Trump on Hong Kong that maybe he understands of what a emotional issue it is for the Chinese. That you can call them lots of names on lots of things. You could fight with them over lots of things, whether it's trade or other issues. But Hong Kong is a red line for them.
As is Taiwan.
And Taiwan, yeah.
And Taiwan. Those are red lines for them, and so treading a little bit carefully there. Now that said, he may not have a choice, because if we're going to be talking about American values and the spirit and substance of this agreement, with Hong Kong. The violations of that are pretty significant, not just for the Chinese internal matters, but they are for all of the partners of Hong Kong and Taiwan.
Yeah, and it's an important point because Congress could take this out of whoever the president is in the future and pass a bill that is so supported by the constituents in America that whoever the president is can't really not sign it.
Go back on it. Exactly. Yeah. So we'll be keeping an eye on that. We also had a little bit of news in Europe. They've been very, very slow with support, but I want to come back and spend a few minutes just talking about what it looks like they may be able to do to give some support to the European economy as they emerge from COVID as well. This is the HPS Macrocast.
Check out HPS Insights, a regular podcast from Hamilton Place Strategies, bringing you the latest on policy debates affecting the business and political communities. Available on your favorite streaming platforms, including Apple, Spotify, and Google. Tune in to the latest episodes and learn more at hamiltonplacestrategies.com/podcast.
All right, we're back on the Macrocast. Europe, we've been focusing so much on the United States and China, but some huge economy, severely impacted by COVID. Because of their structure, they've been slow and clunky in being able to do the kinds of things that we've been able to do very fast and clunky here in the United States, which is, push money out to people to keep them from falling into the abyss. The Europeans are trying to do it. They have this Franco-German plan to push out about $500 billion. John, what do you think is the effectiveness of this? Are they going to get it done?
Yeah, for anybody that's been observing the EU response to the pandemic and seeing just how much deeper the north-south wedge is being driven by this pandemic, it was a real source of concern. Plenty of commentators have focused on the fault lines within the EU, but this was really a very threatening potential issue if the North kept holding a very tight-fisted line, and the South is suffering mightily under the effects of the pandemic. But on Monday, when the Franco-German plan was revealed, it was a potentially a historic watershed. We don't want to get too excited because it still has to be approved next week. So we can talk about it next week. It has to be approved on the 27th by the 27 member governments. And there's still a chance that it gets watered down. Austria is banging on about how it's unworkable and should all be watered down and so forth. But the crux of the issue is that this 500 billion and 500 billion is not that much in the kind of context that we've seen. So that's part of the reason that it hasn't maybe gotten so much play. But 500 billion euros isn't nothing. And really the key issue to highlight is the fact that they are raising the money for this spending on an EU-wide basis, tracking a standard budgetary contribution formula. But it's going to be dispersed to the areas of greatest need. Yeah. And importantly, the distributions, at least in the initial proposal, are largely grants, not loans. This looks like fiscal federalism. This looks like a Euro bond, basically. I mean, it's the same mechanism that a Euro bond would follow, raised by the normal contributions, pan-European formula of budgetary responsibility, and then spent in the places that need it most, which are going to be, guess where? The South. And this is potentially, and the markets definitely sniffed it out. It may not have had headlines, but we saw the euro rally. It's given back some of that. There's some heartburn about how the final decision will go next week, and we can talk about that. But this is a potential game changer for the Eurozone, and we could, you don't want to overhype something, but it does have the potential to be something you look back on years from now and say, wow, that was a real turning point.
Yeah, you just wish the numbers would be bigger to deal with it, though. It seems like they do need more, and we'll see whether they can do it. I mean, ECB is trying to do its part. Everyone has been calling for fiscal authorities to do more. So you do hope they get it done. It is a real departure for the way the ECB and the Commission usually work these things. So
Angela Merkel, the EU must act together. The nation state has no chance if it acts on its own. Which is that's a pretty
sounds very. It's very much like I think Ben Franklin said something similar to me. Must hang together, for we will surely hang separately. Something like that. Yeah.
Yes,
yeah. Hey guys, great discussion this week. Looking forward to next week. Any data we got coming up?
Really, probably the biggest one is the personal consumption expenditures. So we get personal income and personal spending. Then the personal consumption expenditures for the entire United States, and then also within that report we get the PCE price index. So that's the inflation measure that the Fed targets, and the COVID has been very deflationary to global prices, as no one is outside spending.
Yeah, it's going to be fascinating. So at this point, we said this before, but it is just fascinating to see, like, well, what's the number going to be?
Exactly. It doesn't really matter for monetary policy. It's just a fascinating economic data point.
Yeah, just as I'm trying to understand measuring. So, guys, looking forward to next week. Have a great Memorial Day weekend, and stay safe. And we'll catch you next week. This was the HPS Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.